So I wanted to now bring in our next guest to talk about what he's looking at. Ted Oakley, founder of Oxbow Advisors, looking at some of the dividend-paying stocks and what's going on here in the market. And so we welcome in Ted Oakley, founder of Oxbow Advisors. Ted, good to see you. So how are you feeling about the market today?
Well, you know, Nicole, we've had a cash position really most of the year and most of last year really in their stock accounts, even though, we're up for the year with that cash position. So I'm pleased with where we are. But as far as the markets in general, I think what happened was there was so much movement from the Fed, and it really exacerbated the up move on the upside. Had they just left rates at zero, that's one thing. But when they came with the bazooka of everything else, that moved everything further than people expected. And I do think after you get on out a few months and people sort of sober up and look at what's going to be happening over the next 12 to 18 months, we would not be as excited about the market.
I see what you're saying. So you're thinking a little too much from the Fed. They did save the day for the market. We didn't head lower, right? They came in with the bazooka and all kinds of liquidity and backstop in addition to lowering rates. But at some point, they're going to have to stop that too. So you're saying what? We should have some in cash? I mean, you don't think we're hitting new highs? I mean, right now, the NASDAQ hit new highs, but you're feeling a little cautious?
Oh, I'm not saying you couldn't hit a small new high. I'm just saying that if you look at valuations now, we thought they were high in the fourth quarter of 19 going into the year. Well, they're really high now. So if you look at what we look on screens, we don't see many things. That's our problem. And nobody can make a case to us that things are really inexpensive because they don't know what the E is on the PE. I mean, they have no idea what the earnings are going to be. So that's a hard situation, tough to make money in.
That's funny. It's funny because the price to earnings ratio, but if you don't have the real earnings, it's pretty hard to really try and evaluate where a company should be. That being said, you like some of the dividend payers right now. Tell me about some of those picks, why you're looking to those.
We run 3 different strategies, and all of them we have companies that you can own and actually get some nice cash flow. If you look on the medical side, we own a Becton Dickinson convertible preferred that just came out in the last few weeks, really, 6% yield. We really like that a lot. Actually, I heard you mention Broadcom. We own the Broadcom convertible. It's about a 7% yield. We own Pfizer. We own Merck. Those are some things we own. And we like the medical REITs. We have 3 or 4 medical REITs that we like a lot. And all of those yield anywhere between 5.5% and 7.5%. And then we've got really a couple of MLPs we like. There's a lot of places you can find yield. And obviously, they're not in the big FANG stocks. But if you're looking out for consistency, it's a good place to look.
Well, tell me this. So you're talking about, are you looking at the preferred shares versus the common stock? I heard you mention that a moment ago.
Well, we are. We own about 3 convertible preferreds. Now, the convertible preferreds only get issued when times are bad because companies can't go out and sell stock at an exorbitant price. So they back it up for a little while, and they don't want to change the balance sheet. If you remember, they get out, when they look at balance sheets, the rating agencies, they don't like you to take on too much debt and take down that number. So what they do is they'll issue a convertible preferred. You watch Warren Buffett. He buys most of his convertible preferreds when the markets are really bad. And that's what we found this year. We've had 4 or 5 converts come out that are actually really attractive, meaning we'll get the cash flow. And if we get a move in the next 3 or 4 years on the stock, which we think we will, then we'll convert out and go from that way. But it's sort of the best of both worlds.
Ted, when we talk about these preferred, right, when let's say a company goes under, right, the bonds get paid, the preferreds get paid, then the common stock, right? So the common stock is obviously the riskiest investment of all, isn't it?
It is, but from our standpoint, what we look at, number one, even when we're buying a regular common stock, we look at the balance sheets. We run this number all the time. Our EBITDA to debt, And we like those numbers to really be low. We want to be able to pay the debt off in a year and a half or so if we can, and if you see a lot of companies today, Nicole, their EBITDA to debt is not very big, is huge. And so it takes a long time, say 6 years, 7 years, 8 years to pay the debt off. If you look at EBITDA, we don't like that.
Well, that makes sense, Ted. That really does, right? You don't want a lot of debt on the company that you're investing in. Thank you so much. Ted Oakley, founder, Oxbow Advisors.